Hello and welcome to Blue Chip Now, the podcast that gives you insider access to content that we tailor specifically for our clients. Whether you're climbing the corporate ladder or just seeking smart, efficient intel, we've got the answers to your most pressing financial questions. Join us as we break down the markets, debunk the headlines, and keep you ahead of the curve. Let's dive in. Hello and welcome back to another episode of Blue Chip Now. You have Daniel Ducina, Chief Investment Officer.
Matt Mondu, Senior Financial Advisor.
And Dan Cedar, Managing Partner.
You know, it's been a volatile couple of weeks for global markets. Some of the main drivers we've seen are geopolitics, tariffs, and just generally some semblance of a flight to safety. Stocks have whipped around, gold has gone vertical, and investors are once again questioning how much political risk they need to price in, which is very challenging. So what we're going to do today, because of how things have jumped around, is try to highlight 5 of the stories that mattered the most, at least in our view. Sound good to you guys?
Sounds good.
Okay, so number 1. We've had tariff threats returning to the fold, common theme from 2025. But at any rate, tariff threats are once again starting to jolt global markets. Markets were rattled specifically after the U.S. threatened new tariffs on several European countries tied to escalating tensions over Greenland. You had President Trump threatening tariffs on allies including Denmark, Norway, Sweden, France, Germany, the Netherlands, the list goes on, unless they allow the U.S. to advance its interests around Greenland. The plan was to start with 10% tariffs on imports from February 1st, rising to 25% by June 1st if no resolution was reached. So as you might expect, markets reacted sharply. Global stock markets slid, most pointedly in Europe and across the EU, but also in the U.S. You saw equities trading downward. In addition to that, in the currency space, the euro softened as investors moved into more safe havens. Also had volatility spike on this news. The VIX signaled an increase in fear in the markets. Generally speaking, in the U.S., stock benchmarks experienced broad declines, while you saw some gains in the more safe haven type assets such as gold and silver as traders hedged risks. So why this matters, and this will be somewhat of a segue into the next point, but tariffs do directly hit corporate earnings expectations and global growth assumptions. And even though these are hypothetical, it's even the threat of them that is enough to spike volatility. And I think perception is reality, right? So when you have a situation like this, it can very easily get walked back and change, just like we saw thereafter.
Yeah, but so let's break that down. And part of the reason I believe it was changed because Donald Trump views the stock market as a barometer of success. And so if markets are up, he's going to be happy, and that happened under his watch. I don't think any U.S. president wants markets to be down during their time. But as comments are released regarding Greenland and the use of military force, he walks those comments back. It's easy to walk back those comments, much easier than walking back after action is taken. So he walks back his comments, the markets recover, and actually go beyond Monday morning's open. So to me, I think it's a reflection of the market not bullying him around, but in a sense, him being aware of what the market's reaction is, and he wants to accommodate.
Yeah. Well, I guess, as you alluded to, the whole thing is that just days after the initial commentary, markets snapped back, specifically after the U.S. softened its stance. And I guess it makes it challenging as an investor when you have this snappy type of market, because if you have one variable in a person that can dictate the direction of a market, that just becomes challenging, and ultimately you can talk about long-termism, but,
Well, that's it. So what does it mean to our clients? What does it mean to investors? It means you have to stretch out your time frame. So what you can't look at this market with is a lens that is hour by hour or even day by day, because today's news might look different than tomorrow's sentiment or the rhetoric or the headlines. And so day by day is too fast. week by week might even be too fast. You might even need to slow down to look at monthly data. But the further out you look, the more reliable the data will become. In the short term, it's unpredictable and it's unreliable. I would encourage all investors not to view the stock market day to day because it doesn't make sense. It's just an emotional roller coaster.
Yeah. I mean, it's the back and forth right now highlights how like headline driven the markets are right now. And the fact that sentiment can so quickly flip, again, it just doesn't behoove any investor to try to time commentary or time these markets.
Well, when I think, investors have seen enough of this, but they also need to remember, prepare for this. And one way might be, to Dan's point, looking at monthly statements. But the other way is, putting the blinders on and ignoring some of the noise because it is challenging. I mean, people see big swings in accounts and it's real and it makes it tough. But yeah, I mean, the more long-term perspective you can have, hey, reach out to your team at Blue Chip. There's things that you can do to hopefully help.
Yeah, because if you zoom out over a longer period of time, the idea is that over a long period of time, what you've seen in the market will be a reflection of actual fundamentals of businesses, either improvement or deterioration, whereas trading off of like a hypothesis, for example, or hearsay, he said, she said, that doesn't benefit anybody, right?
Yeah. And so let me just take that one step further. So when we say stretching out the time horizon, if you were looking at the markets on an hour by hour basis, you would get an update each hour. If you were looking at the markets on a day by day basis, it means that you would get an update at the end of the market close every single day to help you make your decisions on good or bad. Month by month means intra-month, you're not looking at your accounts. You're not looking at the markets. You're making decisions once a month at the end of the month. Let's stretch it out to year by year. That would be like looking at your accounts once a year only, right? So you have much less noise when you go out further. So stretching that time horizon out reduces the volatility, mitigates the volatility, the volatility in the news.
Yeah. Well, I mean, I think the poster child of that, what you're outlining, is 2020, right? Because if you went to sleep on December 31st, 2019 and said, oh, okay, market had a great year in 2019. You went to sleep for 365 days and you woke up on December 31st of 2020. You said, oh, market had another good year,
yep.
Right?
That's right. Great example.
Yeah. Other action items, you've had the Federal Reserve somewhat in the limelight, not just because of the rate cutting trajectory that they've embarked on, but the whole idea behind Fed independence has been somewhat in question. The Federal Reserve is intended to be an independent body, not housed under the general political structure of the United States. It's an independent body that will be making decisions independently. But there's been some questions related to that under the tenure of the most recent administration. But what I would say is that you're starting to get some of this independence fear getting calmed. You've had markets that have been paying very close attention to this, specifically as members of the administration have been putting an increased amount of political pressure on the Federal Reserve. But you've had volatility starting to fade, at least pertaining to this aspect, as other things have come to the forefront. I would submit that over the next couple of weeks, even some of the macro stuff is going to become a lot less important than, the fourth quarter reads on company level earnings. So yes, the faith in the central bank and their independence is foundational, but I wouldn't be surprised over the next 3-ish months as you continue to see this pop up. If it, I'm going to just guess that this stokes continued volatility as you get rhetoric on this.
Yeah, and I would say this is something that's important. I mean, I don't think it's a coincidence that we've had a relatively strong central bank for quite a long time. We've had strong markets. I mean, there's always your hiccups, along the way in the form of recessions. But, generally speaking, they've done a good job. So, yeah, you kind of want to continue to see that trend continue in the future.
And I'll throw this out, in an environment that is extraordinarily volatile politically, I always say politics plays no role in a portfolio. Really, a lot of us think, because of the polarization between the left and the right, that your political views can have an impact. What the Federal Reserve does is much more powerful than politics.
Mm-hmm.
The Federal Reserve, in moving interest rates and monetary policy, this is what moves markets. It is very, very important. Keep your eye on central banks. Keep your eye on monetary policy. It's much more impactful to your portfolio than the headlines on whatever media station is your favorite.
Yeah. Well, and I mean, clearly investors are paying attention to this because, as we alluded to at the onset of this conversation, one of the clearest signals of investor anxiety is gold and precious metals. You've had gold that has surged to record highs, blasting through $5 an ounce. Central bank buying
$5,000 an ounce.
What did I say?
$5.
$5.
Yeah.
Yeah, I'll take that. Anyways, $5,000 an ounce, record high. You've had central bank buying, geopolitical risk, and generally a softer U.S. dollar that have served to help fuel the rally. And it's not just gold, it's silver and other precious metals as well. So why something like this matters is because of what I said at the onset, anxiety. Moves like this in gold and precious metals usually signal deeper concerns about financial stability or inflation or geopolitical risk, regardless of what the stock market is doing. So I don't think we've seen a run like this in gold in a very long time, but there are a number of factors that have kind of coincided, the dollar and some of the Fed independence items, that have served to beef up the price of gold.
Yeah, and gold's very cyclical. Gold kind of goes through these spike periods and then they decline, and it really goes nowhere for quite a long time. So this is gold's day in the sun, and to all the issues that Daniel alluded to previously, as justification for a rally.
Yeah.
And you also have stocks, that are really, I want to say that we're at all-time highs. So, the opportunity cost of buying gold, which pays no income, no dividends, and stocks that are, dividend yields, all else being equal, are low because stock performance has been so strong. You can see how investors, might allocate a little bit.
Yeah, that's a great point. I'll wrap up with this last bit here. You have broader Wall Street right now that is looking ahead to a very busy 2026. Despite all the noise and all the volatility that we've kind of cited, you have investment banks that are feeling really, really confident. After some pretty strong deal-making momentum, Wall Street expects M&A, IPOs, and general capital markets activity to stay fairly robust in 2026. The reason that this matters is because when bankers are optimistic, it usually signals corporate confidence and a belief that markets will remain open for business. So, these bankers are probably just parroting what they hear from a sentiment perspective from corporate leaders that they're interacting with, right? So, specifically, some recent details that I would call out. Bankers expect high deal flow in 2026, a busy year for deals, continued demand for mergers, acquisitions, and IPOs. Some of that could be related to relatively lower interest rates. You also have major IPOs in the pipeline. Some of the notable ones, potential blockbuster IPO from SpaceX is certainly going to be sought after and well followed. You also have strong investment banking revenue trends. So the broader market data that we see suggests a surge in investment banking revenue overall, with industry fee income reaching nearly the highest levels since 2021, with projections indicating a further step up in 2026. So the fact that you have these robust deal pipelines, strong equity market, and private equity all as drivers, I think that there's some reasons to be optimistic. And then, just kind of closing the loop on it, you have firms, let's call it the bulge bracket investment banking firms in the U.S. that are talking about how robust their pipelines are. And I think that generally speaking, while this in and of itself might not be the most important anecdote to call out, the fact that you see this optimism in the plumbing of our financial system is it should be taken very positively. It should be a source of optimism because numbers don't lie, and the fact that we have a whole heap of interest in whether it's IPOs or just general banking activity, at least on the corporate side, I think that's actually pretty exciting.
Yeah, no, I agree. I mean, that's one of the positives out there. I think it's easy to constantly get bombarded with the negatives and the negative headlines, but generally speaking, I mean, directionally for investors, for markets, it's a good thing.
Yeah. Anything else, guys, before I wrap us up?
Scotty Scheffler.
It's not human either.
No.
Super Bowl picks. Will we record again before? I think we will.
Let's see. Probably 2 weeks? Probably won't.
Well, I'll take the Patriots.
On personal bias alone, I can't watch a team that has dominated the NFL trajectory of my entire lifetime be picked to win again. So, gonna have to go with Seattle.
I'm the last person to ask this question.
Dan just realized who's playing the Super Bowl.
Yeah. So no, but I will say Seattle.
All right.
Because I think the Patriots have had their day in the sun. It's Seattle.
Okay. Well, we covered a lot of ground today. Everything from tariffs, geopolitics, Fed independence, down to some different assets like gold and also banking activity. Thanks for listening as always. We look forward to speaking with you all again soon.